And now it's time for Development Debates, where we dig deeper into some of the questions shaping the future and present of China. Today, our debate question is why the Chinese provincial governments seem unworried by their heavy debts. According to a report published by State Auditing Administration a few days ago, 36 district governments in China ran up debts of $628 billion at the end of 2012, a 12.94% increase of $72 billion compared to 2010. 9 out of 15 capital cities' governments have debt ratios ranging from over 100% to a high point of 188.95%. Amongst all provincial government debts, the highest debt ratio is 219.57%. It should be noted that the financial crisis in 2008 led to these huge debts for provincial governments, as they felt that they were running a successful financial model. They were likely misled by their large fiscal revenues and often balance account statements. However, after their financial crisis in 2008, the Chinese State Council tried to boost the fast-falling economy by announcing a $652 billion economic stimulus plan. Most of the provincial governments followed the State Council's plan and made their own investment plans called the $2 trillion plan. Under these circumstances, the local government's debts dramatically increased in the next few years. That short-term fix was a major factor in current debts. Generally speaking, the development of a provincial economy is often reliant upon a government moderately borrowing money from private or state-owned banks. The internationally recognized warning line for local government debts should be no more than 60% of its GDP. Otherwise, an unstable local economy and severe financial problems would closely follow suit. Oddly enough, the Chinese provincial governments facing the highest debt ratios don't seem worried. Yuan Lifa, the CEO of Shanghai Fidelity Investment Group, explained that the reason why Chinese local governments acted this way, despite still needing to pay off their huge debts. He indicated first that since the reformation of the tax distribution system in China, the State Council has taken the largest shares of taxes, while little is actually left for local governments. This caused a severe debt problem and led to a shortage in cash flow for paying government expenses. The local governments would have faced serious problems a long time ago if it weren't for the revenues from the real estate industry. Nowadays, the only way for those local governments' chief leaders to get promotions is to pass performance appraisal indicators, including the growth rate of local GDP and other financial indicators. Therefore, in order to guarantee the continuation of their government careers, the local governments had to borrow more money and build more debt to help them get through the performance appraisal indicators. The nationalized banks were trying their best to satisfy all the financial demands required by Chinese provincial governments. From the perspective of provincial governments, the national funds that they borrowed would still be acceptable. They believe that the worst-case scenario would be that they can't pay their debts by the time their tenure as an official ends. Even if they can't pay their debts on time, they still believe that the national banks would be willing to allow them to delay their deadlines. The State Council would be expected to pay those debts that they couldn't. Last but not least, the provincial governments have been heavily relying on land revenues. Nowadays, all industries in China are suffering, except for the real estate industry, which will still be as profitable as it was a few years ago. Therefore, those officials believe that no matter how much money they had borrowed, they can pay off all debts by selling land to real estate developers and then continue to gain profits from land incomes, road building, and other complementary markets. There isn't supervision of these local governments' financial problems. There is still little to no transparency in provincial governments' fiscal revenues, and no one until now can tell exactly how much debt all those local governments have built up. It's no wonder that the international ratings institution Fitch Ratings has decided to lower the rating of China's ability to pay long-term provincial debt from A- to A+. With this knowledge, it seems likely that the provincial government's finances will likely have come at the expense of taxpayers in the future.